So next up, we've got a virtual fireside chat from transactions to trust, how intelligent payments infrastructure drives customer retention and revenue. Viraj Gupta, head of product at Stripe, is going to be on screen with us in just a second. So help welcome him to the stage, the virtual stage. Hey Viraj, how are you doing?
Hey, thank you for having me. I'm doing well. Thank you so much.
All right. So we've had a great day yesterday. We're kicking off a great day today. So it's great to have you as well on the stage with me today as well. So to get us started, just introduce yourself a little bit more and your role at Stripe, and then we'll kick into some of the questions.
Sure. I lead a product called the Cards Vault platform at Stripe. And it is a platform that allows the merchants on Stripe to securely store their card credentials with Stripe and then process them either with Stripe or with a third party. In addition to that, there are a couple of important features that we offer as part of that product, including the card account updater and the network tokens. And those features allow the merchants to keep their card credentials fresh and up to date and prevent involuntary churn.
Yeah, I know in research I've done, payment processing, billing, the financial aspect of any business is always like number one on, challenges from a friction perspective, an impact to customers perspective. And obviously you at Stripe are doing some amazing things in that space. So talk a little bit about kind of, card account update or network tokens, intelligent routing, talk a little bit about how you provide those solutions to businesses.
Yeah, so Card Account Updater essentially is a feature that is offered by Stripe in conjunction, in partnership with the card networks. And what it allows the merchants on Stripe to do is to make sure that the card credentials that they have, to keep them fresh. For example, if a card is expired, lost or stolen, and the card is replaced, the physical card is replaced, the Card Account Updater makes sure that the card is fresh and the credential and basically the transaction goes through without any issues. The network token is an alias provided by the card networks, and it is a representation of the physical card. It is more secure than the physical card because it has some security features built into it, including domain controls. It requires a fresh cryptogram to be used for any transactions. So it allows for more secure transactions as well as prevent churn.
Yeah, absolutely. So as we said, I think in a lot of even the audience here, there's a certain aspect of our businesses, like payments is one of those that most people kind of don't think about it. It's just a standard. This is something that happens. And I think a lot of products are kind of like that. A lot of businesses that, they're supposed to be invisible. Right? When they're designed right, they just kind of happen. They're invisible behind the scenes, but critical to trust if they break when they don't. So tell us your thoughts a little bit about how to manage in that environment of expectations versus the criticality and nature of a product like that.
Yeah, so when we think about designing a payment solution, we think about it from two perspectives. One is for the customer who is making the payment. The experience should be seamless. They should not experience any friction. It should be almost invisible to them what is happening behind the scenes. And then the other aspect is to look at the merchant who is offering that service, as well as internal teams within Stripe, and build great details and observability for these teams to ensure that that kind of frictionless experience is offered to the consumers. And what I mean by that is you come up with dashboards, for example, where you look at the authorization rates by markets, by brands, by transaction types, you look at the fraud rates, you look at the latency, and all of those things to make sure that you catch any problems before they become a major issue for your customers. I can give you an example of that. Last year, we were experiencing some higher latency for some of our transactions, particularly the ones that were using network tokens. And one of the reasons for that was that we require a fresh cryptogram to be fetched from the card networks to process that transaction. So it was that round trip latency of us going to the card networks to fetch that cryptogram and then using it to process the transaction. And that was increasing the latency for the transaction. And so we did a lot of changes in our flow to hide that latency behind some of the other processing work that we do when we process a transaction. And as a result of that work, we were able to reduce the latency in the order of tens of milliseconds. Now, this might not seem very high to a customer, right? If you reduce the latency by 50 or 100 milliseconds, does not feel like it's a lot to the customer. But in the back end, we can see that it is making the experience faster for the customers. It is preventing some of the timeouts that happens at times for all of us. So it is preventing some of those bad experiences for the customers, but it is invisible to the customer.
Yeah, absolutely. And we talked a lot yesterday, I know, about kind of friction and reducing friction, making things easier, exactly like that, and from that perspective. And we're talking now about from transactions to trust. And trust is a pretty strong word, that speaks to longevity and loyalty, from that perspective. So when you think about connecting your payment infrastructure to that long-term customer relationship, how do you see that?
Yeah, it is very important for a merchant to offer good payments experience for the customers, and that is critical to building that relationship and that trust with that customer. Usually, when there is a churn, it is one of the two types. There is the voluntary churn and there's the involuntary churn. And the involuntary churn is more often than not the result of something going wrong with the payments infrastructure, right? And in those cases, the customer wants to pay you, they want to continue getting your services, they're ready to pay, and the only thing that is standing between you and your revenue is your payments infrastructure. I'll give you an example. There was a customer of ours who was using a third-party vault, and they were sending transactions for Stripe to process. And in many of those cases, we were seeing that those transactions that were coming in had credentials that were stale. And as a result of that, they had a lot of transactions that were failing, and this was for their subscription business. They did not have the customer on session to provide any updated credential. So it was critical for us to find a fix. It was a significant revenue source for this particular merchant. So what we did was we employed what we call a real-time CAU. And what it does is that as a transaction comes in with a stale credential, we are able to work with the card networks to update the credential on the go. So during the transaction itself, we update the credential to make sure that the transaction goes through. And it was critical in that case for this particular merchant. It helped them improve their customer relationships. It helped them retain some of that revenue that they were otherwise losing. It helped them prevent that churn. So I would say payments infrastructure is so critical to managing those long-term relationships with your customers.
Yeah, yeah. So quick poll of the audience. So how many companies here are B2C? Raise your hand if you're a B2C. Smaller percentage, looks like 15.3% of the audience. So when we think about that and we think about this opportunity to leverage the payment processing and ultimately the impact, like you just described, of how any sort of contextual billing situation and financial situation is so important and critical. How do you look at that in the context of quantifying revenue and impact, and maybe even beyond that into just your use case from a Stripe perspective to an overall billing in a B2B environment as well? How do you look at that revenue and that experience impact to get leadership's attention from that perspective?
Yeah, most of the customers that we work with at Stripe, we typically work with their payment teams, and those individuals on the customer side, on the merchant side, are usually pretty sophisticated. So if I tell them that this initiative is going to increase the authorization rate by 50 basis points, they get that. So we do not really have much of a challenge in talking to or explaining the benefits of a particular initiative to the payments teams. But at the same time, there are other teams within these merchants that may not fully understand the impact of that 5 or 10 basis points increase in the authorization rates. So we work with these payment teams, our counterparts on the merchant side, to come up with a narrative that really makes sense for the other teams that they need to talk to. I can tell you an example of a customer that we worked with last year. And in this case, this particular customer was not using network tokens initially. So we conducted an A/B experiment for them. And through that experiment, we showed to them that the authorization rates were improving in the order of tens of basis points for them. It was also cost effective for them. They were saving some order of pennies in every transaction, but they process millions of transactions. Right? So it was helping them in that regard as well. But we wanted to translate that to a narrative that is well understood by other teams within that organization. And this was a customer they are a marketplace in the ride hailing space. So what we did was we found, in partnership with the payments team that we worked with, we identified transactions that were failing on this particular customer. And because Stripe processes a lot of other businesses as well, we identified those cards that were failing the transaction on this particular customer, on this particular merchant. And are there other merchants that are seeing successful transactions from the same card around the same time? And by doing that analysis, we identified a particular card where the customer was trying to book a ride to the airport. And at this merchant, their transaction was failing because the card was expired. But at the same time, soon after this transaction failed on this merchant, we saw the same card being used at another merchant, their competitor, and they were experiencing a successful transaction because they were using network tokens. So by taking that example, we went to their customer experience team, and we were able to show that this particular customer churned from that merchant because they were not using network tokens and because those cards were expired, and they went to a competitor who was using that, right? So it was a very powerful narrative to show it to the customer experience teams that the impact of these products, the impact of all the background infrastructure that we have in payments, what kind of impact it can have on the customer experience.
Yeah, absolutely. And I think when we look at, in this context specifically, I think, failed payments are one of the only reasons why we fire customers. I mean, honestly speaking, we want to keep every customer we've got unless they can't pay their bill. But so that churn isn't really planned, right? It's a failed transaction. So when you see the failure points, why is it, and how do companies kind of underestimate that problem in their business?
Yeah, I think when we see the transactions failing, it is usually for one of the two reasons. One is stale credentials. So if you think of it, in Canada, when the cards are issued, they're typically issued for a period of 3 to 4 years. So by definition, every third year that card is going to expire, or every fourth year that card is going to expire. So in a given year, you would have between 25 to 33% of the cards that are going to expire. And if that card is on file with you as a merchant and you are dependent on that card to complete your transaction, it is likely going to fail, right? And I think a lot of merchants underestimate this. So I think stale credentials is one of the key pieces that could potentially be addressed to make sure that the payments continue going through. The other important area that I see as being underestimated is the retry logic. So in many cases, let us say the initial transaction failed, but should the merchant retry that transaction? And if they should retry, then how should they retry? There could be many different avenues that you could explore. In Canada, for example, you have dual branded cards. You have Visa or MasterCard logo, but at the same time, you have Interac as another network on the card. Same thing in the US, the debit cards are co-badged cards. So you could potentially choose a different network to route your transaction when you're retrying, right? So there's many different avenues that you could explore to figure out how you should retry. If the initial transaction failed because the account was closed, There's no amount of retrying on that particular credential that would get you a successful transaction. You have to contact the customer, get another payment credential to attempt that transaction. Whereas if the transaction failed because the credit card did not have sufficient credit limit, then you could perhaps retry after a couple of days and maybe the transaction would go through. So there are many different nuances as to why a transaction failed and how you could potentially improve it in your retries. And that requires a lot of sophistication, a lot of understanding of why the payments failed, how you should retry, etc. But in aggregate, those are the two major reasons, the stale credentials and the retry logic. And if the merchants were able to fix some of those core issues, I think a lot of transactions would not fail.
Yeah. We talked in a panel yesterday that we talked a lot about, fraud and how to reduce fraud. And we were just talking earlier about reducing friction, but sometimes there's good friction, right? When we think about the fact that we're fighting fraud. I mean, recently, for instance, my wife got a call from Chase. It said on the pop-up that it was from Chase. They had her full name. I mean, they had information, but as they started asking questions, it was like, wait a second, this is not legit. And so we immediately hung up and called Chase directly and said, yeah, this was not us. So the fraudsters are getting really good at that. So when you think about that balance of unnecessary friction versus fighting fraud, how do you look at that in the context of today's environment?
Yeah, so I think it's a great question. The importance of balancing between creating additional friction while removing unnecessary friction is really important from both the customer experience perspective as well as to make sure that you manage good relationship with your customers and they continue using your services. So the way we see it is there are a lot of fraud detection tools available in the market now. A lot of them are still rules-based. So they would have some fixed rules that if the transaction is above a certain amount, then they would create friction for the consumer. Then they would validate that transaction with the consumer. So there are rule-based systems. And then there are machine learning models that Stripe employs, some of our competitors do as well. And these machine learning models are very sophisticated. So they can take into account thousands of data points around the transaction itself, the merchant, the customer, the card that is being used. So for example, at Stripe, we can see that card being processed not only at that particular merchant, but we have broader Stripe network and we can see that card being used at other merchants. So we can bring that contextual knowledge as well in making a fraud decision for this particular transaction. If we can look at the device data. So there's like thousands of data points that you could use in order to make a decision on whether this is a transaction that is trustworthy or not, or what is the risk level for this particular transaction. So this particular tool that we have, we call it Radar, our fraud intelligence tool. It helps identify these transactions based on all of these data inputs, and it comes up with a score that signifies the risk of that transaction. And we provide that score both to the merchant, and in cases we can make it available to the card issuing bank as well. And then on the basis of that risk score, they can determine whether they want to let the transaction go through. If it is a low risk transaction, if it is a medium risk transaction, maybe you want to let it go, but you want to introduce some friction. You want to authenticate the consumer at the time of the transaction. And if it is high risk, you might want to just decline it outright. So you can make all of those decisions based on the scores generated from this tool. So I think that kind of infrastructure where you use some kind of machine learning model to identify these transactions and assess their risk is very important. I think the other piece that is quite important is the role of the infrastructure itself. So I mentioned about network tokens early on. The good thing about network tokens is that they have domain controls and they require a fresh cryptogram to be used in every transaction. And as a result of that, they reduce the risk of replay attacks, for example. So some of that infrastructure investment could also help in balancing the risk versus creating unnecessary friction for the customers.
Yeah. So when you look at the payments industry, and we'll open it up to questions here in a second, but when you look at the payments industry and the evolution that it's going through, obviously as it is fighting against fraud as it's trying to make things more easier and more frictionless. I mean, I remember thinking of me and some guys back in college a long time ago. We're like, at what point are we going to get an implanted chip, so that we can just pay like that, right? I guess the watch is kind of what you got there, right? But where is payments technology going? Where do you see it, taking the next step?
I think the payments industry is evolving at a rapid pace. Recently, we announced at Stripe during our annual conference sessions, we are pretty big on agentic commerce, and I think that is one of the big areas that is going to have a material impact on the customer relationships, customer experience. How do customers purchase goods? If they can make those purchases through surfaces like ChatGPT or Copilot, Gemini, etc., then those are the surfaces that are controlling the consumer experience. And from a merchant standpoint, it is important that they present their products and their details of the products in the right manner in those surfaces, right? So you as a merchant would still want to show the image of your product properly. You want to show the description of your product properly. You want to show the inventory information, the price information, all of those accurately. So I think that is one big piece that I think is going to have significant impact in years to come.
Awesome. So I want to open it up to questions. Anybody in the audience? We've got some questions for Viraj. Right in the middle. Got a mic. There we go.
Hello, good morning. Thank you for the valuable insights. My question will be, you were mentioning about how you were seeing competitors doing transactions when, for example, you are facing some customers declining cards or declining payments, and so my question will be, how do you design this process of looking out for competitors in order to see or find better experience for the customer? Because yesterday we were hearing a lot about, it's all about the customer, right? And of course, it's customer experience, but you need to know and you need to be aware of what others are doing. So is there a process for you to be aware of what they are doing?
Yes, so I'm assuming by competitor, you mean the competitor of our customers. Is that correct?
Yes, she said yes.
Okay, all right. So the vantage point that Stripe as a payment processor has is that we process for a lot of businesses. There's like millions of merchants who process their transactions with Stripe. So we are in that privileged position where we can see the transaction trends across multiple merchants, and a lot of those merchants operate in the same industry. So from our standpoint, we could look at the transaction patterns among different competitors in the same industry. But obviously, when we present the insights or competitive benchmarking for a particular customer, we would obviously have to make sure that we don't reveal the identity of the competitors that we are presenting the competitive analysis on. So we ensure in our internal processes that there is a minimum number of competitors in this industry, for example, so that we can present the analysis that the customer is asking for, but at the same time, hide the specifics of a particular competitor when presenting those insights.
Very good. All right, she gave you a thumbs up. So any other questions for Viraj? All the way up front. Oh, sorry, there were two. Okay.
Really quick question. It's going to be like a devil wears Prada question, very straight cut. Two countries reacting to the same situation. One country solves it very considerately, putting the customer first in the same situation would be fraud. The other country, defensive, does not know how to solve it and relies upon human and computer-generated reactions to get the wrong information. How would you support the two countries when it's A, very supportive, kind, considerate, going into court is going to be amazing to see the win, The other countries have failed because they've relied upon human solutions and AL to get the wrong solution.
Sorry, I did not quite understand the question, like how is it related to payments?
Fraud. So if there's a fraud payment, one country handles it very differently than the other. And the difference is putting the customer first. As a person who deals with that, what would you say to the countries to be supportive?
So if I understand it right, you're saying that there are two different countries. One is putting the customer first, and they are trying to reduce the fraud as much as possible through human intervention, and the other country is trying to use machine learning models or help from AI to fight the fraud. Is that correct understanding?
Supplementary. So one country does both, the other country does both. We're both going in with full intention to go into AL and bring in technology to human connection. The approach is bias, discrimination, how you approach a customer to get the results that you want to maintain the customer versus, I would say, customer experience, attack the customer and not keep a customer around. How would you support the two countries, one going through great transformation, the other struggling?
Yeah, so I think it has to be a combination of both technology and human intervention. So in the example that we spoke earlier about, we provide, for example, fraud scores to our customers, and then using those fraud scores, they can either make decision on their own without any human intervention, or in other cases, they could deploy some kind of friction that could be through, an OTP or, a customer service representative calling the customer and trying to validate that it was a transaction that they actually originated. So I think it has to be the combination of the two that I think is very critical for these, when you maintain a balance between the customer experience as well as the risk associated with those transactions, managing that risk.
All right. Well, we are out of time, so thank you very much. I appreciate it. Viraj, thank you so much for joining us today virtually for a great conversation.